Imagine two neighbors who earn exactly the same salary. They live on the same street, drive similar cars, and shop at the same grocery store. On paper, they look identical, but one has $20,000 quietly sitting in a savings account, while the other ends every month hoping nothing unexpected happens. Now ask yourself a simple question: which person would a bank rather have as its customer? Most people assume the obvious answer is the saver. After all, banks advertise savings accounts, encourage deposits, and celebrate financial responsibility. Yet the reality is far more surprising. A customer with healthy cash reserves is often much harder to profit from. They are less likely to miss payments, rely on expensive credit, panic during emergencies, or accept unfavorable loan terms out of desperation. Their savings create something far more valuable than interest income. They create choices. Think about what happens when the car suddenly breaks, a job disappears, or an unexpected medical bill arrives. One person immediately reaches for a credit card. The other calmly pays the expense and keeps moving. Same emergency, completely different future. This is where most financial conversations miss the point. The true value of cash is not the interest rate. It is the freedom to wait instead of rushing, the freedom to negotiate instead of accepting, the freedom to invest when opportunities appear instead of selling in panic. That quiet flexibility changes every financial decision that follows. So before we talk about interest rates, investing, or economic uncertainty, we need to understand how banks actually make money. Because once you see where their profits really come from, you'll understand why someone with $20,000 sitting safely in cash represents a very different kind of customer. Not dangerous, not mysterious, and certainly not someone banks literally fear. Instead, they are simply far less dependent on products designed to solve short-term financial stress. And that subtle difference reshapes the entire conversation about what real financial security actually looks like. The next question is why that business model matters more than most people ever realize today at all. Together, the first thing to understand is that banks are businesses, not charities. Their goal is to earn consistent profits, and they accomplish that by managing money, risk, and customer behavior. Savings accounts matter, but they are only one piece of the puzzle. When you deposit money, the bank gains access to funds it can use to support loans, investments, and daily operations. In return, it pays you a relatively small amount of interest. Then, it lends that money to borrowers at much higher rates. The difference between what it earns and what it pays is one important source of profit. But lending is only the beginning. Credit cards, personal loans, auto financing, mortgages, refinancing, overdraft fees, late payment charges, and other financial products often generate far more revenue than a standard savings account ever could. A customer who repeatedly borrows, carries balances, or pays avoidable fees may unintentionally become one of the bank's most profitable relationships. Consider two customers. Sarah keeps 6 months of expenses in cash, pays her credit card in full every month, and rarely needs a loan. David spends everything he earns, carries a revolving balance, refinances debt whenever payments become difficult, and frequently pays interest. Both use the same bank, but their financial behavior produces very different results for the institution. This is why the phrase that banks fear savers can be misleading. Banks do not fear financially responsible people. They earn less from customers who avoid expensive borrowing. A prepared customer has options. They can reject unfavorable offers, shop around for better rates, delay unnecessary purchases, or pay cash when emergencies appear. That distinction matters because marketing often encourages the idea that every financial product exists primarily to help you. Many products genuinely provide value when used wisely. A mortgage can make homeownership possible. A credit card can offer convenience, rewards, and consumer protections. A business loan can help an entrepreneur grow. The problem begins when temporary borrowing quietly becomes permanent dependence. Once someone depends on debt to solve every unexpected expense, the bank's revenue usually increases while that person's flexibility shrinks. Interest compounds against them instead of for them. Financial decisions become reactive instead of intentional. Understanding this business model is not about blaming banks. It is about recognizing incentives. Every financial institution responds to profit, just as every consumer should respond to long-term self-interest. When you understand those incentives, the real importance of building meaningful cash savings becomes much easier to appreciate, and the next piece of the puzzle reveals why cash offers benefits that go far beyond the interest it earns. More importantly, liquidity changes negotiations before borrowing even begins. Someone with cash can compare lenders, wait for promotions, decline unnecessary insurance, and avoid accepting the first offer because time is no longer an enemy. Those choices reduce costs quietly, year after year, which explains why the conversation naturally shifts from banking profits to the surprising power of cash itself waiting just ahead for every viewer to understand completely before moving forward. The biggest misconception about cash is that it only earns interest. In reality, cash earns something far more valuable: options. Imagine two neighbors who both lose their jobs on the same Friday afternoon. Their resumes are equally strong, their experience is similar, and the job market is equally uncertain. Yet their next few months unfold in completely different ways. The first neighbor has almost no savings. Rent, groceries, utilities, and insurance still have to be paid. Within days, every decision becomes urgent. They accept the first job offer, swipe a credit card for unexpected expenses, and postpone long-term goals simply to stay afloat. The second neighbor has $20,000 set aside for emergencies. Losing a job is still stressful, but panic never takes control. They can search carefully, negotiate salary, reject poor opportunities, and focus on finding the right position instead of the fastest escape. Notice that neither person became wealthier the moment the emergency happened. The difference existed before the crisis. Cash created time, and time created better decisions. This pattern appears everywhere. A sudden medical bill no longer forces high-interest borrowing. A broken transmission becomes an inconvenience instead of a financial catastrophe. A market crash becomes an opportunity to invest rather than a reason to sell. A family emergency no longer means choosing between helping loved ones and protecting your own finances. Cash transforms impossible choices into manageable decisions. This is why experienced investors often describe cash as dry powder. It may seem inactive during calm periods, but when opportunities arrive, liquidity becomes incredibly valuable. If stock prices fall because markets panic, someone with available cash can buy quality assets without selling existing investments at the worst possible moment. Critics sometimes argue that every extra dollar should always be invested. That advice sounds logical until real life interrupts. Emergencies rarely wait for perfect timing. They arrive unexpectedly, demanding immediate cash, regardless of market conditions. Without liquidity, people often sell investments after prices have already fallen or borrow at expensive interest rates. Either choice can erase years of careful planning. The overlooked truth is that cash is not competing against investing. It is protecting your ability to remain invested when life becomes unpredictable. Think of it as financial shock absorbers on a car. You hope they are never tested, but when the road suddenly turns rough, they keep everything else working properly. Once you begin viewing cash through that lens, the question changes. Instead of asking how much interest your savings earn, you start asking how much freedom they create. And that leads directly to another important question. Why does $20,000 seem to appear so often in financial advice? Is it simply an arbitrary number, or does it represent a practical tipping point where risk begins to shrink and confidence begins to grow? The answer has less to do with the number itself than the protection it provides against life's most expensive surprises. And that's exactly what we'll explore next, because context matters most. The biggest objection to keeping $20,000 in cash is opportunity cost. The argument sounds simple. Every dollar sitting in savings could have been invested instead. If the stock market averages higher long-term returns, why leave money earning less? It's a fair question, but it assumes life unfolds exactly as planned. Real life rarely does. Imagine investor A and investor B. Both build diversified portfolios, both contribute consistently, and both expect decades of growth. The only difference is that investor A keeps no emergency cash, while investor B maintains a $20,000 reserve. Months later, markets suddenly fall 30%. At the same time, both face an unexpected expense of $15,000. Investor A has no choice but to sell investments while prices are depressed. Losses become permanent because the money leaves the market before any recovery. Investor B, however, pays the bill from savings and leaves every investment untouched. When markets eventually recover, the portfolio participates fully because nothing was sold. This example illustrates something many online debates ignore. Opportunity cost works both ways. Yes, cash may earn lower returns during strong markets, but forced selling, high-interest debt, missed investment rebounds, and emotional decisions also carry enormous costs. Those costs simply do not appear on a monthly statement, making them easy to underestimate. Liquidity acts like insurance. You hope you never need it, yet its value becomes obvious the moment circumstances change. Nobody complains about paying for home insurance after a fire. In the same way, a healthy cash reserve protects your broader financial plan from events that cannot be predicted. There is another overlooked benefit. Cash gives you the confidence to invest more aggressively with the money that is actually invested. When your emergency fund is secure, temporary market declines become easier to tolerate because your everyday expenses are already covered. Instead of worrying about next month's rent, you can think about the next 10 years. None of this means unlimited cash is always the best strategy. Holding far more than you realistically need may reduce long-term growth if inflation steadily erodes purchasing power. The goal is balance, not extremes. Cash should support your investment plan, not replace it. The smartest investors rarely think in terms of cash versus investing. They think in terms of cash for stability and investments for growth. Those two goals complement each other instead of competing against each other. Once that balance becomes clear, another question naturally follows. Why do so many financial experts mention $20,000 as a meaningful milestone? The answer is less about the number itself and more about what it can realistically cover for the average household. Of course, your ideal emergency fund may be smaller or larger depending on your monthly expenses, job stability, family responsibilities, and insurance coverage. The principle never changes. Sufficient liquidity reduces pressure, and reduced pressure usually leads to smarter financial decisions when uncertainty inevitably arrives. Every dollar has a purpose, and knowing which purpose matters most is true wealth. The number $20,000 appears in countless articles, podcasts, and conversations about personal finance, but it is not a magical threshold handed down by economists. Instead, it represents a practical milestone that covers many of the financial shocks an average household is likely to face without immediately falling into debt. For many families, $20,000 can cover several months of essential living expenses, major vehicle repairs, insurance deductibles, emergency travel, unexpected medical bills, or temporary unemployment. It provides breathing room while life settles down, giving people the ability to think clearly instead of reacting under pressure. Unlike viral financial advice that promotes one universal target, your emergency fund should reflect your actual lifestyle. Someone spending $2,000 each month has different needs than someone spending $8,000 every month. A single professional may require less than a family supporting children or aging parents. A simple calculation works surprisingly well. Start with your average monthly essential expenses. Multiply that number by 3 to 6 months, depending on your income stability, career flexibility, and personal comfort with risk. The result becomes your starting point, not your final destination. As your income grows, your responsibilities change, or your career becomes less predictable. That target should evolve with you. There is another reason this milestone feels so powerful. It changes your psychology. People with meaningful emergency savings often negotiate salaries more confidently because they are not desperate to keep every paycheck. They are more willing to leave unhealthy workplaces, wait for better opportunities, question expensive purchases, and ignore high-pressure sales tactics. Financial security quietly changes behavior before it dramatically changes net worth. Think about buying a car. Someone with no savings may focus only on the monthly payment because immediate affordability is all that matters. Someone with cash can compare financing options, negotiate the purchase price, or even delay the purchase until a better deal appears. The same transaction suddenly produces completely different outcomes. That emotional shift is difficult to measure, yet it may be the greatest return your savings ever generate. Confidence reduces costly mistakes. Patience creates stronger decisions. Flexibility opens doors that panic keeps closed. So, if $20,000 is not magic, why does it deserve attention? Because it represents a level where many people stop surviving 1 month at a time and begin making decisions from a position of strength. That mindset becomes the foundation for everything that follows, including long-term investing, career growth, and lasting financial independence. Remember, the destination is resilience, not perfection. Even reaching 5,000, then 10,000, creates meaningful progress. Every milestone increases your ability to absorb surprises without borrowing, proving that steady preparation consistently beats last-minute desperation every single time forward. The truth about financial independence is that it rarely begins with millions. It begins with removing urgency from your decisions. When every bill feels like an emergency, you cannot think long-term. You simply react. People who build meaningful cash reserves often appear calmer, but that calm is earned, not inherited. They can negotiate harder because they are not terrified of missing one paycheck. They can decline bad offers because they have time to wait. They can ignore panic headlines because tomorrow's groceries are already covered. Consider two investors during a recession. Both understand the same market data. Both believe quality companies will eventually recover. Yet one sells everything after reading frightening news because rent is due. The other quietly keeps investing because an emergency fund protects daily life. Their intelligence never changed. Their liquidity did. This illustrates an overlooked principle. Money changes behavior long before it changes wealth. Confidence encourages patience. Patience improves decisions. Better decisions compound over years into stronger financial outcomes. Fear, by contrast, compresses time and pushes people toward expensive mistakes they would never make under calmer circumstances. Financial independence is often imagined as luxury homes, early retirement, or seven-figure portfolios. In reality, its first milestone is much quieter. It is the ability to say no without risking financial collapse. Once urgency disappears, opportunities begin to look different. You notice better jobs instead of grabbing the first one. You compare insurance policies carefully instead of renewing automatically. You negotiate major purchases with confidence because walking away becomes a realistic option. Even investing feels different. Market declines become invitations instead of threats because your emergency fund separates today's bills from tomorrow's wealth. That mental separation is incredibly valuable. It allows logic to replace emotion when everyone else is reacting. And once you recognize that freedom starts with preparation, the final step becomes surprisingly practical. Building and maintaining the right cash reserve for your own life, using consistent habits instead of dramatic shortcuts. That's where lasting resilience truly begins for almost everyone, regardless of income level or career stage, and it is exactly what we'll build together next. By now, the goal should feel much clearer. Building a $20,000 emergency fund is not about chasing an impressive number. It is about creating enough financial breathing room to make better decisions when life refuses to follow your plans. Start by calculating your essential monthly expenses. Focus on housing, food, utilities, insurance, transportation, and other necessities. This gives you a realistic target instead of relying on someone else's situation. Next, automate your progress. Schedule a transfer into a dedicated savings account every payday, even if the amount seems small. Consistency matters far more than perfection. Small deposits made month after month eventually become meaningful protection. If you are carrying high-interest debt, prioritize reducing that burden while still building a modest emergency cushion. Eliminating expensive interest payments often provides a guaranteed financial benefit that few investments can match. Whenever your income increases, resist the temptation to inflate your lifestyle immediately. Instead, direct part of every raise, bonus, tax refund, or unexpected windfall toward your emergency fund. Those occasional boosts can accelerate your progress dramatically. Most importantly, remember that your target is personal. Someone with a stable career, low expenses, and excellent insurance may need less than someone supporting a family or running a business. The right number is the one that lets you sleep well at night. Once your safety net is in place, you'll discover that money no longer feels like something you're constantly chasing. Instead, it becomes a tool that quietly supports better choices, and that brings us to the biggest lesson of all. Once your safety net is in place, you'll discover that money no longer feels like something you're constantly chasing. Instead, it becomes a tool that quietly supports better choices, and that brings us to the biggest lesson of all. $20,000 is not a magic number. It is a symbol of preparedness. It represents the ability to face uncertainty without panic, protect your long-term investments, and avoid expensive decisions made under pressure. Real wealth isn't measured only by how much you own, but by how many bad decisions you never have to make because you planned ahead. Start today, deliberately,